If you can break yesterday's costs into fixed and variable pieces, you're halfway to knowing what your costs will be tomorrow. In management accounting, we call that whole process cost estimation, and the payoff is simple: using past cost data to forecast future costs for real decisions and your exam questions. Think of it like checking last year's electricity and rent to guess next year's, but doing it in a structured way that management can trust and use. There are fancy statistical methods out there, but in practice, managers lean on simpler techniques because they are quick to apply and usually accurate enough for planning and short-term decisions. The first simple technique is the account classification method, where the manager goes through each cost item in the accounts and decides whether it behaves as fixed, variable, or semi-variable. Fixed costs stay the same within a relevant activity range. Variable costs move in line with activity, and semi-variable costs have both a fixed part and a part that changes with activity. Once each item is classified, the manager assigns numerical values, usually by looking up historical cost records and adjusting them for expected inflation to bring them up to future price levels. This is very similar to how you build up a direct cost per unit, where you estimate direct materials and direct labor per unit by pulling past data and adjusting it for anticipated changes. Here's how it looks in practice. A manager wants to estimate future production costs, so they list rent, supervisor salaries, machine maintenance, raw materials, and factory wages from the accounts. Using account classification, they treat rent and supervisor salaries as fixed, raw materials and factory wages as variable, and machine maintenance as semi-variable that partly stays and partly grows with output. For each of those items, they look up past cost figures, adjust them for expected inflation, then total the fixed items, the variable items, and the fixed and variable portions of maintenance to get an overall cost per unit. The estimate they create is useful, but here's the catch. Its accuracy depends entirely on how realistic their classifications and inflation adjustments are, because this method leans hard on judgment. The second common technique is the high-low method, which takes a semi-variable cost and, using cost data at the highest and lowest activity levels, splits it into a fixed part and a variable part. It's fast, but it has a weakness. It only uses 2 observations, so unless those high and low points properly represent the whole relevant range, the fixed and variable split is only a rough approximation. To use more of the available data, managers can turn to the scatter graph method, plotting several past cost observations against the activity level, and then sketching a line of best fit through the points. That line gives an estimated fixed cost at the intercept and a variable cost per unit from its slope, but it still depends on subjective judgment in how you draw the line, so the result is an informed estimate, not perfection. So your exam takeaway is clear. Cost estimation means using past costs to forecast future ones, and simple methods like account classification, high, low, and scatter graphs are widely used because they balance effort with useful, though approximate, accuracy. If this made cost estimation feel more concrete, subscribe so you catch the next lesson, where we keep turning textbook cost behavior into clear, exam-ready thinking, one concept at a time.